Get ready to make money. This is Gregory Collier. I am primarily a gap trader. I love trading gaps. I love being done trading by 11 a.m. Eastern Standard Time, and I'm able to do it quite often by following certain rules. Now, I trade gaps in the short term. I do quick scalps and day trades. There are longer term gaps. I'm going to talk about the quick scalps and day trades in this video. There's 6 common morning gaps that I trade. And this little cheat sheet may come in handy for you. Just make a print screen and you'll have it forever. So there's 6 common morning gaps that I trade, and there's a lot of different terminology among the trading universe. What I call a gap is when the price of a stock opens at a level that's different from where it closed on the previous trading session. So if a stock opens up higher than where it closed on the previous trading day, that's a gap up. If it opens lower than where it closed on a previous trading day, that is a gap down. Now, there are a lot of traders who only consider a gap to exist when the price of a stock opens above the previous day's high price, meaning refer to that as a true gap, or opens below the previous day's low price, calling that a true gap as well, a true gap down. Now, I do look at those particular levels, and those might be the basis of a support or resistance level for me in my determination of how I actually trade. But I'm focused on the difference between the opening price and where it closed on the previous trading session. And there are 3 different types of plays that I like to make. The first one is to trade the actual gap fill, which many call fading the gap. Now, a gap, from my experience, of anywhere between 1 and 2%, that is more likely to fill. And a gap of between 2 and 4% or even more is more likely a candidate for a gap and go situation where the strength of the move just continues based on algorithms firing that particular direction, whether it be long or short, and either people chasing a move or selling off in a panic. So the first move is trading the gap fill. And if I want to be extra aggressive, I'll enter as early as 9:31 a.m. Eastern Standard Time. I don't just jump in blindly. I make sure I have a confirmation. And doing this entry, I will enter once the 9:31 candle breaks above the 9:30 candle, for if I'm playing things to the long side based on a gap down. If I want to take on less risk and it's far safer to wait for the opening range to be established, I'll wait till 9:45 a.m. Eastern Standard Time, and I can see basically how the market has opened and make a determination. Now, a lot of times wait until 9:45 because gaps often fill super fast at the open. A lot of times I will miss that particular gap fill or the attempt for the gap to fill. And there comes in my second play, which is to trade the reversal. A lot of times I will wait to trade the reversal. So if a stock gaps up and its natural first move is for it to come down, I will often wait until the price of the stock starts to turn at a support level, whether that support level is the gap being filled by touching the previous day's closing price, or whether it's hitting the previous day's high price or previous day's low price, or some other level that I may have mapped in my pre-market planning. In the current market environment where the market is backstopped by the Fed, and if you don't know what being backstopped by the Fed means, just do a Google search, you'll find a lot of information on it. In the current market, when there is a gap up, this is my favorite play. To wait until there is a reversal and play the bounce, to wait for a stock to go down and play the bounce off of the reversal. That's a play that I often do. The third play is the gap and go trade, the trading the continuation. If the gap doesn't start filling right away after market open, especially by 9:35 a.m. Eastern Standard Time, There's a possibility the gap won't fill at all based on the strength of the directional move. Now, in my particular case, I only trade a few stocks. I trade a few stocks, generally 4. So I watch these closely starting in my pre-market planning. And at the time of this video, it is 8:50 a.m. Eastern Standard Time on Tuesday, September 22, 2020. Apple is the #1 stock that I trade, followed by Tesla and Nvidia, followed by Alibaba. So I'm looking at Apple on the 15-minute chart. I keep extended hours on most of my charts. Now, if I didn't have extended hours on in the pre-market when I'm looking, I wouldn't actually be able to see graphically what has happened. So this gray area, this is a pre-market, after hour / pre-market trading. The black, this is the previous day, and I'm looking at Thinkorswim, and this is a live version of Thinkorswim. I am going to go into paper trading to do some illustrating later on in the day, or I'll use Thinkorswim on demand to complete this video. But we can see that Apple closed at a particular level in the previous trading session, and Apple has gapped up. So this would be a candidate for Apple to pull back at the open. And so a lot of times this actually happens in the pre-market, sometime between 9:15 a.m. and 9:30 a.m. And I'll jump in short with the stock. And then after the open, then I can make a play with options if I desire to make a play with options. But I only do it once I see a confirmation on that 931 bar. So this is one way I actually look at the stocks that I trade. Now, I also, in my pre-market analysis, I keep a watch list in CNBC. And CNBC, if I have extended hours, if I have a watch list created on CNBC and I have extended hours on, CNBC gives me the actual percentage. So Apple is up 1.8%, Tesla's down 4.7%. So this Tesla, that's a candidate for a gap and go, but it's also a candidate for if it does not continue to fade to the downside right after the open, to play that bounce. Another tool I will use is I'll use TradingView. This is actually a 30-minute chart. The gray here is the after hours trading. The yellow here is the pre-market trading, but we can see where Apple closed on the previous trading session, and we've got a gap up. Now going to the Thinkorswim platform, if you go to Market Watch and then you select the drop down, there's a bunch of watch lists. Under G, there's a watch list called Gap Up. If you hit gap up, the watch list will display. Now, these are stocks. If you're doing this in the pre-market, it's only going to show what gapped up yesterday. But if you wait till market opens, it will populate immediately, and it'll actually show you what stocks have gapped up from the previous trading session. And a lot of traders will trade multiple stocks, even stocks you're not familiar with. Well, this is the way that one could actually go ahead and see what has gapped up, by how much it's gapped up, and make a determination of whether you want to make a trade or not. Another tool is potentially using, this is Webull. I do have a Webull account. I like Webull. I don't think it's the greatest for day trades or scalps, but it's got a nice desktop app and a nice iPhone app. Webull has a section where it shows pre-market movers. So there's another way to actually find some things that have gapped up or gapped down. Before I go any further, let me talk about intraday time frames. I focus on gap trades up to 10 a.m. After that, I use completely different strategies if I'm still trading, and typically by 11 a.m., I am done trading for the day. I'm often in a gap trade prior to 10 a.m. and I might hold it. I might hold it all day long. Depends on how the trade plays out. But I focus on gap trades up to 10 a.m. These rules are from a book called Power Trading, Power Living by Michael Parnes, and I think they are fairly accurate. A lot of people ask me, why is it so choppy after 10 or 11 a.m.? Well, that's what just generally what often happens. Chop can happen at any time, but this is I think a good guideline. And let me explain the 10 a.m. rule. If a stock gaps up, you should not buy it long unless it makes a new high after 10 a.m. Conversely, if a stock gaps down, you should not sell it short unless it makes a new low after 10 a.m. I find this rule very accurate. I break it all the time, and I have some nice wins when I break this rule. But for risk management purposes, this rule does really, really work because gap trading is that powerful. As an example of the 10 a.m. rule and why it works, going back to August 12th, you can see that Apple gapped up significantly from the previous day. The natural first move is for the stock to go down when the stock gaps up. So if you actually go long right away, you're taking on a big risk. But if you wait till after 10 a.m., after a new high is made after 10 a.m., you see a lot of times when that happens, the stock just keeps going higher. So at 10 a.m., Apple was at 111.37, and it just kept going. It went all the way up to 113.25. So there was an opportunity to get a nice win right there by following the 10 a.m. rule, and this happens quite a bit. It is 10:12 a.m. Eastern Standard Time on Tuesday, September 22, 2020, and I'm looking at a 15-minute chart of Apple in TradingView. On the left here, see where Apple closed on the previous day, extended hours pre-market, and then we see where Apple opened. First 15 minutes, Apple sold off. This was a potential opportunity to go short if using my first scenario, expecting the gap to fill and then confirming it. But let's see how I would have confirmed this. This green line here is the ATR trailing stop that I display in TradingView. For the purposes of this gap trade, gap trades are often so fast, I don't necessarily use this particular indicator. I'm going to go to the 1 minute chart and see how the 1 minute chart behaves. So if I deemed it appropriate to take this level of risk, the break on the 931 bar below the 930 bar might have caused me to go in and short. This is far easier to do with stock than it is to buy put options. I would have had to deal with a little bit of pain had I done this particular trade, but there was a gain opportunity for sure. Let me go to a chart of the 110 Apple put options. That's the option that I would have potentially played if I was playing it to the short side. And we could see that if I had entered around that time frame, 932, extra risky, I would have had to deal with some pain. And then there was a gain opportunity. If I waited until 9:45, there was really no play for me to make with the actual put option. At this particular point in time, I actually probably would have lost money had I entered that late. Let's go back to the trading view and see how things looked at 9:45. I'm going to go to the 5 minute chart. And 9:45 on the 5 minute chart. 9:45 on the 5 minute chart would have told me, okay, we're bearish, but we're not as bearish as we need to be for me to enter this particular trade. I see this tail. I'm like, I'm not entering there if I see that tail. This actual 940 bar would have told me, nope, cash in if you already have your gain. But once I saw this tail here, I got to get out. I got to get out because it looks like things are turning around. Let me go to the 1 minute chart and see how the 1 minute chart looks. I'm going to look at 9:45. So there was a little move to the downside, and then we see the things move up. And at this particular point, there's no way I'm still in a short trade right here. I get out. looking at a 15-minute chart on Tesla, was there a gap play? Well, Tesla closed at a particular level on the previous trading day, and it gapped down more than 4%. Anywhere between 2 and 4 is a strong candidate for a gap and go play, a continuation of the move. Well, greater than 4%, it certainly could be considered a gap and go play. Let's go to the 5-minute chart. We can see that Tesla on the 15-minute chart did pull back the first 15 minutes. Let's go to the 5-minute chart and see what happened. 5-minute chart, Tesla actually bounced on the 5-minute chart. Let me go to the 1-minute chart. So the natural first move on a gap down is to move higher. Well, this move higher on the 930 bar, I would not have entered on that because I always wait till 931. I can see that 931 bar did not continue higher. It took things down, so I certainly would not have gone long. Once we got to 932, if I wanted to take the risk, I would have been short right here. However, we can see I would have had to deal with quite a bit of pain. So I would have needed to confirm this with a longer chart. Let's go to the 5-minute chart. Would that have been confirmed with a 5-minute chart? Well, it would have been confirmed with a 5-minute chart, but not until 940, and even then, Tesla turned and bounced. So we saw that the 940 bar broke below the 935 bar. This just would have been likely. Had I done this trade, I would have used small size and stuck to my guns, feeling that because Tesla was down and we did have some decent sell volume, more sell volume would come in. But that would have been a trade I would not have been as comfortable doing simply because of the fact that Tesla is so erratic. Let's go to the 15-minute chart on NVIDIA and see how NVIDIA may have been played with gap trading rules. So it looks like NVIDIA did gap up from the previous trading day. It had an okay gap up. So this would have been a situation where I would have expected a move to the downside as the natural first move of the stock after the market opened. Let's go to the 1-minute chart and see how I would have confirmed this based on the candle formation. Now you can see that the 930 bar had a large amount of sales volume. The 931 bar was a continuation. I may have entered here had I wanted to go short. You see, no matter what, in trading, you're going to have to deal with some level of pain, some level of shaking out of weak hands. But if you enter early, you can't have weak hands. You have to know that there is a possibility that you can lose and have some risk loss parameters. But this would have been a decent play, and it did go down a good amount before it started to chop around 9:50 a.m. Eastern Standard Time. In terms of profit and losses, here goes a profit and loss cheat sheet. I primarily scalp and day trade at the money or one strike price out of the money options. So my generally when I'm trading an option that expires this week, I take my profits at a 10 to 20% gain based on my capital at risk. And I keep those same exact levels for my stop losses. Now those are mental stops. I never enter hard stops with an option. I sometimes do that when I'm trading stock. If I'm trading the next week's options, my profit target is between 5 and 10%, as well as a 5 or 10% max loss. When I'm trading futures or stock, generally half of a percentage point is my max loss for a stock, and 2% for futures. So I'll also take that as my gain threshold. As long as I win more than I lose, I'll be profitable as long as I let some winners run, I'll be profitable. The thing I can't do, the biggest thing I can't do is I cannot let losses run. So if I hit a 20% loss, unless I really see that it is turning to in my direction with some major strength, I have to cut my loss at that particular point in time at the absolute latest. Now I'm looking at Amazon on the 15-minute chart in Thinkorswim. So we see where Amazon closed on the previous day. Amazon opened up greater than 2%, but less than 4%. This is often a gap and go candidate. We see that Amazon did come down in the first 15 minutes, which when something gaps up, the natural first move is down. Let's see how it looks on the 5-minute chart. We can see that it did go down. It started to lift. We see stronger sales volume right at the open. Let me take a look at the 1-minute chart, see how the 1-minute chart looks and how I might have played this as a gap trade at the open. So what jumps out at me is we have kind of a doji here, so I would have been a little cautious as to the direction. If nothing else, I see a high shadow and a low tail here. So the next bar was bearish, but the fact that I see this tail, I don't like tails. I see a tail, that's a warning for me, particularly if I'm considering going short on this 931 bar since the 931 bar broke below the 930 bar. If I'm considering going short and I see this tail is telling me that it's weaker because the bar opened here, it closed here, but in the process it did go much lower and lifted. So if anything, I want to sit on hands. And then when I see this, I'm not going to enter short here. And I'm also not going to enter long here. I'm going to wait and see what happens with the next bar. The next bar is a doji. So I have to sit on hands right there. Then I have to think of what I might do if I'm still interested in playing Amazon. Because as Amazon does start to fade, I have to consider the fact that, okay, maybe there's an opportunity for me to trade the reversal when Amazon starts to fill the gap or stops, where it either fills a gap or where it reverses after trying to fill the gap. And it looks like that is where a potential opportunity was. So waiting the entire opening range till we get to 945, we see that Amazon starts to break out at 950 and just bolt higher. So certainly there was an opportunity right here. Maybe some weak hands get shaken out. That's why, you can use level 2 to help you determine whether you're going to stay in something or not. I'm going to flip this to the 1-minute chart just to see that range on the 1-minute chart. And we see, a hammer form here. This is likely, if I wait for strong confirmation, this is likely where I enter right here, 9:49 a.m. Eastern Standard Time. So say I enter at the top of that, roughly 3008.6. I can ride that really all the way to certainly 3031. Maybe a potential shakeout here, but that was an opportunity to play the reversal clearly on Amazon. Let's go to Alibaba. Let's flip to the 15-minute chart. So Alibaba did gap up from the previous day, and it was an okay gap up, sold off hard at the open. Let's see what the 1-minute chart tells me. So if stock gaps up, the natural first move is down. Alibaba had some strong sell volume at the open. That's not the time to enter. I wait till the 931 bar. The 931 bar broke below the 930 bar. This would have been something potentially I go in short on Alibaba, either with put options or shorting the stock. So we see that if I enter anywhere here, say I enter at the low point of that 931 bar, Alibaba's at 274.37. There's an opportunity to get, you know, a $3 move, $4 move, you know, maybe even better, or sit on hands and wait and see if there's going to be a reversal off of the gap fade. And in this particular case, that reversal was short-lived. If we waited till the 9:45 time frame, here's 9:45, 9:48. There was a lift, and then it started to go down again. So this, in essence, is gap trading. If you just remember that the natural first move is in the direction of filling the gap generally, there's often an opportunity to capitalize on that. Then there's an opportunity to capitalize on the reversal when that gap does not fill, or when the gap has filled and the reversal takes place. And then there's also the opportunity for the gap and go if the strength is really, really high. And you can tell if the strength is high if you see consistent volume in the direction that you're trying to trade. I hope you like the video. I'll try to do some better videos in the future. Hope everybody has great trading. If you decide to do some gap trading, I suggest you start with paper trading and practice it. Write out your strategy on paper. Make sure you know the particular moves you might want to make with gap trading. And good luck with it. Gap trading is a great opportunity to make money. There's a phenomenal book that I have in my highlights called Power Trading, Power Living by Michael Parnes. He has 2 entire chapters on gap trading. He has the greatest explanation of gap trading I've ever seen written. The book is outdated. There are some things in the book that are not accurate relative to some regulatory changes that have taken place in the capital market since his book was published. But it's still a phenomenal book on trading, and particularly on trading gaps.